Hello everyone, this is CA Dhananjay Bhave, faculty for Financial Management and Cost Accounting. In this video, I'm going to discuss CA Intermediate September 2024 question paper in a quick summary. So here is the question paper. I'm first discussing the descriptive part. We will go to the MCQ part later. So the section A was all financial management. Yes, starting with question number 1A. This question is a combination of cost accounting and financial management. By the way, in this video, I'll not be solving the sum in detail. I'm giving you an overall picture for those students who are preparing for January 2025 and May 2025 examination. You'll get an understanding of how question paper is and how questions are drafted and how you should prepare for your upcoming examinations. Okay, so this question number 1A is a mixture of cost accounting and financial management adjustment. Actually, if you see the question, sub question 1, you can see contribution, they have asked margin of safety, and they have asked sales. If you just read plain simple, it sounds like a pure costing, marginal costing question, but they have clubbed that with risk and leverage chapter. I've made a PDF summary of all these questions, that is the questions that are in the question paper, the marks, the chapter, and the variety, the nature of the question, and also a reference question, similar question that we solved in the class. So those who have already attended my class will be able to go through that and also practice these questions. Okay, so question number 1A, they gave two companies, N Limited and C Limited. Equity share capital, debt is given, fixed cost is given. By the way, you have debt with you, 5 lakh rupee. On that, if you apply the rate of interest, you get the interest amount, and then fixed cost is given. Combined leverage and financial leverage, both the information is given. Now with combined leverage and financial leverage, you know you can work out operating leverage, and using operating leverage and fixed cost data that is with you, you will be able to find out contribution also and EBIT also. I hope all of you remember the formula. DOL is contribution by EBIT, and you know DFL is given as 2 and DCL, combined leverage, is given as 8. I'm referring to N Limited. If you know how to do it for N, you can do similar workings for C Limited. Using that, you can find out DOL, and once you have DOL, since fixed cost is with you, you will also be able to find out contribution amount, fixed cost amount, and EBIT amount. And I already discussed debt is there, so you can find out the interest amount as well. And the question is find out contribution. Just now I told you how to do it. And then margin of safety in percentage for N and C Limited, sales of C Limited only. Now here comes a challenge. It's a part reverse working question as well. The reason is you have combined leverage, and what is the formula for combined leverage? Contribution divided by EBT, and to find out EBT from EBIT you have to minus the interest. From there you should be able to get the contribution data, and there is a formula in cost accounting, margin of safety. If you are able to find out margin of safety, total sales minus break-even sale. Now to find out break-even sale, you need to know fixed cost as well as PV ratio. So this question in a way is a very, very tricky question, given that you have both cost accounting as well as financial management adjustment. I gave you an overall hint. You'll have to basically draft an income statement and fill the available data, and using DFL and DCL, you have to find out DOL, and from DOL you'll be able to get contribution, EBIT, and with the interest you can get EBT. From there you will be able to complete the answer. This question, according to me, is a new variety question, a tricky question, because it has an adjustment of both costing and FM. Question number 1B is from ratio analysis, working capital management topic. A very, very easy question. According to me, this is the easiest question in the question paper. You have all the details necessary to find out operating cycle. I'm just taking you through the sum. Cost of production is given, cost of goods sold is given, average WIP, average FG is given, admin selling expense, collection period, raw material storage period, and creditor payment period. In fact, they've worked out half of the sum, right? Because you don't have to do receivable collection, raw material storage, and creditor. You only have to do the balance part. You are required to calculate the working capital requirement by operating cycle method. Now to do operating cycle method, you need 5 factors. RM period already given in the question. You have to work out WIP period. For that they have given cost of production to you and average stock. By the way, read the last part of the question. They have mentioned already, assume 360 days in a year. Most of the times in day-to-day class you have this worry, sir, if I take 360, my friend takes 365 and we're getting different answer. I told you not to worry even in the class, and here you see you have a good example in front of you. 360 days are given. So coming back, raw material period already mentioned in the question. WIP you need to work out. FG you will have to work out. For that COGS is given in the question, and average stock of FG is also given to you in the question. Debtor is already given, creditor is already given. So you need to work out first operating cycle period, and when you then do 360 days divided by 1 operating cycle period, you will get to know number of cycles, and then working capital is equal to annual cost divided by number of cycles. I hope this everyone has understood. One of the easy questions according to me. Cost of goods sold is with you, admin and selling expenses with you. If you add cost of goods sold plus admin and selling expense, you get the total cost, and there is no depreciation, there is no non-cash item asset, so we don't have to even worry about cash cost or total cost, etc. It's simply annual cost divided by number of cycles. One of the easiest questions from working capital management. Yes, let's move on to question number 1C. Following information relates to MNP Limited for the year ended 31st March 2024. By the way, this is a ratio analysis question. Balance sheet preparation, a type of reverse working question, and as you can see in the question, they have given balance sheet format, they've even given equity share capital and reserves and surplus, also creditor. You only have to find out these 4 numbers, question marks, and one more here, and as you know, the total of the balance sheet has to tally, and this is a 5 marks question. Guys, I've repeatedly told you in the class, whenever you see questions like this, there are 5 numbers to be found out. You can make out 5 question marks, and question is for 5 marks. That means each working that you do is going to give you marks, correct? Let me just zoom the screen. Yes, yeah, you can see it's 5 marks question, and you have 5 question marks. By the way, I'll also be attaching the question paper PDF. You can download it from the link in description box. So even if you're not able to do entire sum, if you're able to find out 3 numbers out of 5 numbers, yeah, first of all, half balance sheet is ready. And even if you do 3 out of 5, you'll still be getting 3 marks out of 5 marks. So working notes are very important. And in case for some reason, if balance sheet doesn't tally, even if you have done 3 workings properly and 3 numbers properly, you're going to get 3 marks, not to worry. So coming back to the question, you have inventory turnover ratio based on COGS. That means they have used COGS formula and not the turnover based formula. Second, total asset turnover ratio. Long-term debt to shareholders fund. By the way, shareholders fund is share capital plus reserves and surplus, and long-term debt is a question mark, and long-term debt to shareholders fund they're talking about, that means it is long-term debt divided by shareholders fund, 0.6 divided by 1. That means if you do this one thing also, you get long-term debt amount, and once you get that, you get total of the liability side, because you can see in the question all other 3 things of the liability side is already there in the question. You only have to get that one more thing. You get the total liability, and that itself is total asset. And once you get total asset, I already read total asset turnover ratio, you can then find out the sales. Yeah. After that, debtor collection period, using this you can find out debtor, and they have also mentioned in the question last line, all sales are on credit basis. That means there is no cash credit breakup, so all sales are on credit. With this you can find out debtor. GP ratio is given. I already told you how to find out sales. From there, if you take out this GP, you get COGS. From there you can do inventory, you can do inventory turnover ratio. With that, even the inventory number is ready. And then you have current ratio. Creditor is the only current liability. From there you can find out total current asset. Out of that, I already discussed debtor and inventory. Then cash will be the balancing figure, and once you get that, you already have total asset, inventory, debtor, cash, all 3 are ready. Fixed asset is the balancing figure. I think this is also a very easy question from ratio analysis. Yeah, we have done a lot of questions in the class, much tougher than this, much detailed than this. This according to me is a bonus to you in exam. Yeah. All right. Let's move on. Question number 2A, 8 marks question. This is from cost of capital. They have given capital structure of T Limited. You have equity shares, debenture and preference share. All the numbers here 10 rupee, 100 rupee and 100 rupee. That means these are all book values. All right. Next, additional information. Risk-free rate of return 10%, beta is 1.75, return on market portfolio 12%. The equity share has a current market price of 70 per share. By the way, last line of the question, I'm just reading that first and then we'll come back. Last line of the question, they want you to work out weighted average cost of capital after tax. Obviously, for interest we will do 1 minus t. Now if you need WACC, you need to first find out individual cost of capital. So first information is all for your equity. You have risk-free return RF, you have beta with you, and your market rate of return, which is RM. That means you need to use CAPM approach. I hope most of you know this. Cost of equity is equal to RF plus beta into RM minus RF. Instead of giving dividend, growth, etc., here they have given CAPM based cost of equity calculation. You have RF with you 10 plus beta 1.75, open bracket, RM 12 minus 10 RF. With that you will get cost of equity, that is working note number 1. Second, debentures are trading at a market price of 80. The debentures are to be redeemed after 5 years at par. That means this question is debenture with redemption. So it is not only I into 1 minus t, you also have to consider RV, redeemable value, and net receipt, that is today's issue price. By the way, little later I can see adjustment number 5. They have mentioned that the cost of debenture is to be calculated using YTM approach and company's tax rate is 30%. By the way, favorite of many students, when they say YTM approach, yield to maturity, you will have to do it using trial and error. Remember, it is IRR technique. So you have year 0 and then you have year 1 to 5 years here. Your debenture is after 5 years. So here your table is year 0, year 1 to 5 and year 5. And this has to be done with trial and error because your target is to get 0, correct? That is why they have given present value trials also. One is 10%, another is 14%. Another reason we keep worrying in class, sir, when we do IRR, what if our trials are different and our answers are different? Our latest batch students know this very well, correct? But you see here, everybody has to take only these two trials, 10 and 14, and that's also an hint. Also a hint to you, answer is somewhere between 10 and 14. Yeah, so 10% you may get a positive number, correct? 14 you may get a negative number, and a cross multiplication using IRR style you'll be able to find out KD. All right, and every year when you take I, it is not just interest, it is I into 1 minus T. Perfect. So here working note 2 KD. I quickly repeat, working note 1 was KE using CAPM model. Working note 2 is cost of debt with YTM model. Then comes preference share. Adjustment 3 are redeemable after 5 years at a premium of 5%, presently selling at 104 per share. When they say presently selling, this is the ongoing market price. By the way, this is again a question with redemption. Cost of preference share, KP with redemption, correct? Formula will be preference dividend plus RV minus NR divided by N whole divided by RV plus NR by 2 into 100. Here anyway, for preference share there is no question of tax. Yeah, you only have to check the dividend rate. I think dividend rate was already there. Yes, here it was 12%. So you'll have to consider 12%. And remember, 12% is always on the par value. Then why did they give you market price? That's because when you do WACC, final answer is not WACC book value, it is WACC market value. That is the reason. You see last line of the question, you're required to calculate WACC after tax. Obviously we are doing I into 1 minus T using market value weights, right? So working note 1 KE, then KD, then KP, and WACC market value. When you do market value, you have to take number of equity shares and multiply by its market price. Do not copy the number from the first table. These are all book values. You should not copy this, correct? You have 50 lakh rupee divided by 10, you will get to know how many equity share. That you multiply by market price of 1 share. 40 lakh rupee divided by 100, you'll get to know how many debentures, that you multiply by market price of debenture, and same way for preference share as well. This is an easy question asked for 8 marks. Here the only thing that could take some time is working out the YTM, because you have to do some trial and error and also then cross multiplication. This can take some time, but this is not a tough question or not an impossible question. We have done a lot of questions like this in the class already. Yeah. All right. Next, moving on to a small theory question. Explain angel financing. This is from types of financing, a complete theory topic where we discussed venture capital, startup financing, seed capital, assistance, bridge finance. In that discussion, we've also discussed angel financing. This concept is from that particular discussion. Next, question number 3. This is from working capital management, receivable management. A very simple question on debtors. They have given existing credit policy and they're also planning to change the existing credit policy. Now the question is whether changing the policy is a good idea or not. Let me take you through the question. AB Enterprise deals in hardware material having current turnover of 30 lakhs. All sales are on credit as of now. Average collection period is 30 days with 0 bad debts. As of now, 30 lakh credit sale per annum and 30 days time given. Customers are requesting increase in the period. As a result of increasing credit period, sales is also expected to increase. This is something very common. You have seen in a lot of questions that we discussed in class. Whenever you extend time, more customers will buy and your regular customers will also buy more. Correct? Both will happen. We have discussed this many times. Credit policy only A and B. Very small answer. You already have present and proposed A and proposed B. Increase in collection period 15 days, 30 days. By the way, you are already giving 30 days. Read the third line of the question, first para. You're already giving 30 days. You're planning to make it 15 more. That means 30 plus 15. And as of now, you're running with 30. If you go for policy B, it will be 30 plus 30. So you're planning to make it 60. Increase in sale is 3 lakh and 5 lakh. You're already selling 30 lakh. First para, second line. In future, it will be 33 lakh, 35 lakh. And bad debts, as of now, it is 0. In future, it will be 1% and 3.5%. Bad debt is a percentage on sales, not on cost. So this 1% should be applied on sales value. All right. After this, let's see what else you have. The selling price is given. With this, you can find out number of units. Variable cost per unit is given. So when you multiply this with the variable cost, you'll get to know total variable cost. And fixed cost is 5 lakh rupee. Good news, this 5 lakh is not going to change. Whether you stay with present policy or go for policy A or policy B, this 5 lakh will be same. Now, required rate of return on additional investment is 20%. This is to be used for opportunity cost. Now, how to calculate opportunity cost? Total cost into rate of interest given, which is 20%, into number of days. As of now, it is 30 days. And also here they have given assume 360 days. So currently it is 30 by 360. In future, it will be 45 by 360 and 60 by 360. Here is a small new adjustment that they've added. They're saying creditors for variable cost are, look at this, are ready to give 15 days extra credit for the additional cost incurred. This is a new adjustment. Now, what does it mean? When you want to sell more, you will also have to incur extra variable cost. And they are saying creditors for variable cost, that means do not take this for full cost, not for fixed, only variable cost. They are ready to give 15 days extra credit for the additional cost incurred. So whatever is the ongoing cost that you have for the 30 lakh sale, that proportionate variable cost, that will continue to be there as it is. The additional sales that you are doing, for that there will be some additional variable cost, and that money you need not have to pay immediately. You are going to get 15 days time. Now sir, how is this going to impact our answer? Now this is a benefit to you. How is it a benefit? When we are selling goods to debtor, we cry our money is blocked and we say opportunity cost, opportunity lost, correct? Our money is blocked. But now for that extra sale that we are making, we are getting the benefit from creditor. So we'll have to consider this as a benefit. So our answer will be something like this: sales minus variable cost minus fixed cost minus opportunity cost plus opportunity gain. Now what is this plus opportunity gain? This will not be there in the existing column, but this will be there in the new proposed policy A and proposed policy B. In proposed policy A, you're going to take variable cost number into 15 days by 360 into rate of interest. That becomes your gain. And in proposed policy B, though you are giving 30 days time to your customers, your creditors are only giving you 15 days time. So though there is some benefit, it's not too much of benefit. But when you go to policy A, there is good benefit because you are also giving 15 days extra time and you are getting 15 days from your supplier. In a way, you're not going to lose extra opportunity money in that policy A. But in policy B, you are giving 30 days, but you are getting only 15 extra days. This, according to me, is the only new adjustment in this question paper. So I quickly repeat what I said. You have sales minus variable cost minus fixed cost minus opportunity cost. Till this you anyway know. But now we have to even consider opportunity gain. For the present column, there is no opportunity gain. In future, you have to take only variable cost number, multiply by same rate of interest, multiply by 15 days by 360 days. Variable cost into rate of interest into 15 by 360 for policy A as well as policy B. You may be giving 30 days to your customers, but your creditor is giving only 15 days in both policy A and policy B. No benefit available in the current credit policy. Okay, some authors and even ICAI study material, ICAI, when they come up with the suggested answer, they may show opportunity cost as the net number, that is opportunity cost minus opportunity gain, net opportunity cost. You can even present it as minus opportunity cost first and then add opportunity gain because you're getting some time benefit. Alright, otherwise there is no difficulty in this question. Assume 360 days. You are required to analyze the present and proposed policy using total approach method. Now in my class, we have done some similar questions where I said if they mention incremental approach in the question itself, then you only have to show extra sales and extra cost. Remember this, extra sales and extra cost. Here they have clearly mentioned do it using total approach. That means you don't have to show extra sales. You have to show total sales, total variable cost, total opportunity cost. This is much easier because in incremental cost there is a chance of you doing a mistake. In total you will never do a mistake. So it is particulars at present 30 days, in future plan A, plan B, sales, all total figures, minus variable, minus fixed, minus opportunity cost, plus opportunity gain, and net benefit, whichever is better, that policy we will have to choose. Okay, let's move on. Question B, this is from capital structure question, very simple question. We have done a lot of questions on this, similar sums, almost same sum we have done it. I'll also be attaching one more PDF in the description, every question that is there in the question paper and a similar or same question that we have done in the class material. So those who are preparing for future exams, you can practice, and if you have attended my class, you have all the notes, so you can refer to that, and I want you to solve all these questions and check once institute releases their suggested answers. Okay, let's move on. ER Limited has paid up capital of 2.5 lakh consisting of 25,000 equity shares of 10 rupee. As of now, simple 25,000 into 10, 2,50,000 fully funded by equity. Market price of the share is 24 with a PE ratio of 8 times. Do you remember? PE ratio formula is MPS by EPS. Market price of the share divided by earning per share. Now, PE ratio is with you, left hand side is 8. 8 is equal to market price 24. That means 8 is equal to 24 by EPS. When you cross multiply, you will get 3 earning per share. Now if 3 is earning per share and if you have 25,000 equity shares, 25,000 into 3, 75,000 rupee will be total earning available to equity shareholders. I quickly repeat, PE ratio formula is MPS by EPS and left hand side PE ratio is 8 already given. So 8 is equal to market price 24 divided by EPS. On cross multiplication, you get earning per share as 3 rupee. There are 25,000 shares. If you multiply 25,000 into 3, you get total earning available to equity shareholders. 25,000 into 3, 75,000 rupee. Simple. Let's move on. The company is planning to purchase a plant which will cost them another 5 lakh, and that is going to yield earning before interest and tax of 2 lakh rupee. Remember, this is EBIT. This is not earning available to equity shareholders. Yes. Now how to arrange this money? They have two alternatives, plan A, plan B. Lot of questions like this we have solved in class. 100% equity, that means entire 5 lakh rupee will come from equity shares. Second plan is 50% coming from equity, 50% coming from debt. That means out of 5 lakh rupee, 2.5 lakh from equity and balance from debt. They said cost of debt is 12%, that means this is the rate of interest, and this is applicable only for alternate B, because in alternate A anyway there is no debt. Second, equity share of face value 10, which will be issued at a premium of 10 rupee per share. Very important. That means when you issue one share now, you're going to get 20 rupees. Yeah. So I'm just discussing alternate A. You need 5 lakh rupee. And if you go for 100% equity, entire 5 lakh rupee will come from equity shares. How many shares? 5 lakh rupee divided by 10 plus 10, 20. So 5 lakh by 20, that will tell you how many new shares you will have to issue. This will impact your EPS calculation, correct? For EPS in future, you need existing number of share plus new shares. The new shares should be calculated like this. Total money coming from equity divided by 10 plus 10, that is 20 rupee. PE ratio of a levered company is 7. Very good. What is leveraged company? A company having debt. Correct? Company having debt. Now, in alternate A, there is no debt. That means this is an unlevered plan. But if you go for plan B, that is with the debt, it will be called as levered plan. Correct? Levered is the one having debt, unlevered is the one without any debt. So this line is applicable to alternate B. Yeah, using that you will be able to find out the using this you will be able to find out how much is going to be MPS, how much is going to be EPS in future. Yeah, tax rate is 40%. This is required for your EPS computation. Advise which alternative is most suitable to raise funds for additional capital, keeping in mind to maximize the benefit to shareholders. That means you'll have to find out earning per share in future. Earning per share in future. You already have some shares, remember, in the first paragraph. So you'll have to work out in future how much is going to be your EPS. Whichever gives you better EPS, that option should be selected. Easy question, simple question. No need to break your head, and you have only two alternatives. Actually, in the class, we have worked out a similar sum that also had financial break-even point, indifference point, correct? And we did one class sum also. I did one sum and you did one sum. And those who have attended the class, they know these questions, similar questions are there even in the part B. Alternate plan A, plan B. If you remember, PQR, XYZ, 100% equity, 50% equity, 50% preference, 50 equity, 50 debentures. Multiple plans were worked out. Here they've asked only two plans. Much easier than the question that we did in the class. So last question in FM is theory question 442. You only have to attend one of these two. So this is 2 or 2. So don't count it as 4422. It is 4, 4 and just 2. First one, discuss any two advantage and two disadvantages of raising finance by issue of debenture. This is from types of financing. In the initial pages of the topic we have discussed in the class, equity share, advantage, disadvantage, small table. Next, debenture, advantage, disadvantage, preference share, retained earnings. All four sources of fund, advantage and disadvantage. You only have to write two advantages and two disadvantage. See this, I keep telling you in class not to ignore theory. They have asked a 4 marks theory question, so clearly mentioned two advantages, two disadvantages. That means if you can write one correct point, advantage of debenture, simple answer, sir, we save tax. So tax benefit will give you 1 mark and it will not dilute the earning per share. Two advantages and you get 2 marks. Please do not ignore theory. All those students who will be writing exams in future, costing or FM, do not ignore theory. This 4 marks is easier to score than the practical problems. And two disadvantages, very easy, it will increase the risk, financial leverage, and when the risk increases, even equity shareholders expectation will increase. You will have huge outflow. You have to repay debenture and mandatorily every year you have to pay interest. Even in the year of loss, you don't have choice. There is no flexibility, correct? And you have to create a charge. I gave you 4 or 5 disadvantages. You only have to write any two. This was the most easiest theory question anybody can ask. So do not ignore theory. Yeah. Next, list out 4 assumptions of Gordon model. There are a lot of discussion in class related to Gordon's model. Remember, there is growth, there is constant growth, there is perpetual life, K is greater than G, company will always pay dividend, companies are in profits, shareholders are rational. Remember bird in hand theory, shareholders are rational and they do not want to take too much of risk, so they expect dividend every year, and also they expect growth to be there in the company, and all companies have perpetual life. Tax rate is not there, taxes are not there, it's a common assumption. They've asked you to write any 4 of these assumptions. Last question, what is leverage lease? Again, this question is from types of financing. Leveraged lease is when lessor takes bank loan and purchases an asset and gives that asset itself on lease, and the lessee pays some amount to the banker and some amount to the lessor, and once the bank EMIs are all clear, the lessee will pay all the rentals only to the lessor. We have discussed this with an example, we have written a small diagram also, most of you have copied this. Very simple question. They've asked for 2 marks, so you don't have to write more than 2-3 point. Understand, leverage means taking debt, making use of others' money, correct? If you can recall that one term also, you'll be able to understand. Lessor will take loan from bank and will lease that asset to somebody, and that lessee will pay some money to the lessor and some money to the banker, because loan has to be repaid, and once the loan is repaid, all the rentals will go to lessor. Very simple question. Last one is remedies of overcapitalization. We have discussed in detail in the capital structure topic. At the end there was a table, overcapitalization, why it happens, how to avoid this, taking too much money than necessary, correct? Internal reconstruction problem, somebody is giving loan at less rate of interest and we take too much of it. What is the remedy? They have asked first of all to repay the debt, not to create excessive debt, reconstructing the balance sheet, talking to all debt holders, and I think you have studied this even in accounting, a topic called internal reconstruction, a very small simple theory question for 2 marks on that. Yeah, with this the financial management question paper is over. From here whatever you have is strategic management question paper. So overall in my opinion question paper was very easy, except 1 or 2 new adjustment that will happen every time, has to happen according to me, otherwise things will be too boring in life. Yeah, and time will not be a challenge because strategic management is anyway a theory paper. So even if you have taken 1 hour 30 or 1 hour 40 minutes for financial management practical portion, financial management portion, you would have completed a balance of strategic management in 1 hour 10 or 1 hour 15 minutes. Many students told me SM was not lengthy also. So whenever you have a practical paper and the theory paper together, you have this small advantage also with you. Let me see if I can open MCQ file as well. Yes, yeah, here it is. This was the MCQ file, and in MCQ the initial question was on strategic management. After that, case scenario 1 was on financial management. So let me quickly zoom this. This is a case scenario. Yes, RS Limited is manufacturing and selling soft drinks in India. The production process involves one important process which increases blah blah blah, a big story. Basically this question is a capital budgeting question. Here they've given year 1 2 3 4 5, additional sales, selling price, variable cost, additional fixed and selling and distribution cost. So you can take units into price, you'll get to know sales, and then variable cost, when you multiply you get total variable cost, and then minus the fixed selling and distribution cost. After that they have given cost of acquisition of automated machine 5 lakh rupee. This becomes your year 0 cash outflow. Residual value at the end of year 5, this is scrap value, is 50,000 rupee. Depreciation on automated is on SLM basis, so you can easily work out SLM method. This is for CFAT, from sales. When you take out depreciation, variable cost, fixed cost, depreciation, you get PBDT. Take out depreciation, they have mentioned SLM method, and then find out tax and then add back depreciation so that you can go back to CFAT. And they have also mentioned savings, and I have discussed this many times in the class. Money saved is money earned. This saving should also be taken as an inflow. This has to be added. This is a cash inflow to you, must be taken. And then machine which is being used at present has 0 written down value, and if sold it will fetch an amount of 10,000 only. That means in books it is worth 0, but when you sell it in the market you'll be able to get 10,000 rupees of cash. So this becomes your year 0 cash inflow, because you're buying a new machine, the old machine can be sold. Discount rate is 10% and tax rate is 30%, and this will be used for your NPV calculation. And they've also given year 1, 2, 3, 4, 5 present value factors, so no question of rounding of differences. If they have given 3 digits 0.909, you also take 3 digits and work out. Very simple question. Instead of asking this as a descriptive question, they have converted this into 5 MCQs. Look at this. What is the NPV of the investment proposal? That means you have to do full sum. Year 1, 2, 3, 4, 5, first depreciation, and then CFAT table, and then full NPV calculation. And then they've asked discounted payback period. You have year 0, you have CFAT numbers, you have to multiply with DF, you get cumulative, and then with cross multiplication you can find out discounted payback period. And then they want PBT for year 2, 3, 4. Now this PBT will come in your table, PBDT minus depreciation, PBT, that number they want you to tick. And then what is the cash inflow after tax for year 1, 2, 3, again comes from the same CFAT table. What is the discounted cash inflow after taxes, again comes from the same table. So basically they did nothing, they just converted a 10 marks capital budgeting question into 5 MCQs of 2 marks each. Therefore you really do not need additional preparation for this type of MCQ. They only converted a detailed descriptive question into a small 5 MCQs. This will take time. This question is actually time consuming, but worth it, because you're going to get 10 marks. So even if you spend 15 to 20 minutes, it's not a loss of time, because it's going to give you good marks as well. Now this is a small question on risk and leverage. Sales 6 lakh rupee, variable cost given, if you minus you get contribution, fixed cost given, you will reach EBIT. Financial leverage is given, from EBIT with financial leverage you can reach EBT. Yeah, and then they are saying percentage change in sales required in order to double the EBIT. Very good question. When they say double the EBIT, that means EBIT should increase by 100%. You have to do a cross multiplication now. Read once again. Percentage change in sales required to double EBIT. That means they are connecting sales with EBIT. This will happen using DOL. Correct? Suppose DOL comes to 2. What is the meaning? 1% change in sale, 2% change in EBIT. Now they want EBIT to change by 100%. A cross multiplication will tell you how much should be the change in sales, and that is what they want in MCQ. Very good, simple question. I think very suitable for MCQ style. Not a detailed one. You don't have to even do a big table for this. Yeah. Next question is on cost of equity. This is dividend plus growth model. I'll quickly take you through. They've given 5 lakh equity shares of 10 each. Market price is 75 rupee. Company has declared to pay dividend on equity share 6, which will be paid within next 3 days. That means this is D0. This is the dividend of last year, related to last year, that is going to be paid today, tomorrow, within just 3 days. So you can count this as D0. They said company has a history of consistent growth in dividend. That means it's not a constant dividend. That means you cannot use D by K formula. You have to use D1 by KE minus G formula. They said it has been predicted that in the next year KPS Limited will pay dividend on its equity share 7.59. Look at this. They have said 6 rupee D0. They said D1 will be 7.59. That means in your numerator 7.59 will be taken. And this is also a hint to find out growth rate. How to find out growth rate now? As of now 6, it will become 7.59. That means 7.59 minus 6 will tell you how much is the increase per year divided by base number 6. So it is 1.59 by 6 into 100. This is the growth percentage. Yeah. The rate of dividend growth will be maintained in future. Cost of equity is calculated as dash. So here you already have price of the share. Look at the second line. Price of the share is 75. Remember the formula, P is equal to D1 by KE minus G. Actually it is KE is equal to D1 by P plus G, and you shift G. I have discussed this repeatedly in the class. They already have left hand side 75 and future dividend is 7.59 divided by KE. You have to find out minus G. I just now discussed how to find out G. Good question according to me, and very suitable question for MCQ. Won't take much of time also. Another question DuPont model, this is from ratio analysis. Remember, DuPont model is a combination of three factors. Yeah, equity multiplier, asset turnover ratio, net profit margin. And what they have given, total asset 7,20,000, shareholders equity 4,50,000. Using this, you can find out equity multiplier. NP margin is 12.5, asset turnover is 1.5. Now you have to put all three formulas: NP by sales, sales by total asset, and total asset divided by equity multiplier. Substitute all the available numbers and then you will directly get the return on equity. I quickly repeat: net profit by turnover or sales, turnover or sales by asset, asset by equity. You can see in the first two lines they have given asset and they have given the shareholders equity. That means one part is ready. Equity multiplier, they've already given NP margin 12.5%. that means 12.5 by 100, since it is percentage, you can even put it as 0.125. Yeah, and asset turnover is already given 1.5, so it is simple multiplication, very easy. And this is only for 1 mark. No surprise, because there is nothing much to do. Yeah, and this case scenario 2 is from strategic management, not my part to discuss. And even 13th question, 14th question is all from strategic management. Yeah, even 15th and 16th. Yes, I think with this, financial management question paper discussion is over. Hope this session was of some use to you. Please check the description link. I'll be sharing this question paper and also reference questions that we did in the class material for all of you to practice by yourself. Thank you so much for watching. Take care. Bye.